For most people, the stock market is a wealth generation tool, allowing for slow and steady gains over time. But for those who lose patience, try to take shortcuts, and ultimately make mistakes, the market can be just as effective at wealth destruction too, if not better. And that means you could potentially lose money a lot faster than you make it. My goal with this video is to share with you 5 dire investing mistakes that could cost you thousands and thousands of dollars. But first, I do have to mention that I am not a financial advisor, and this isn't any kind of personalized financial advice. If you're new here, my name is Ryan Scribner, and I post weekly videos here on the NerdWallet YouTube channel, so make sure you subscribe and hit the bell. Now, before we get into the 5 beginner investing mistakes, I want to show you why losing money through making bad investments or bad investment decisions is so painful in the long run. What we're going to do is hop over to the NerdWallet website and use the compound interest calculator. So click the top link below and follow along. Okay guys, so here we are over on the NerdWallet website, and the first thing I want to do here is take a look at a simple example of investing $50,000 and then earning 10% interest with 20 years of growth. And we're going to punch that in here under the investment details section and see what we'd be looking at here as a potential return. Now, as far as why we are using a 10% interest rate, well, that's because NerdWallet has found the average stock market return, not accounting for inflation, has been about 10% per year for nearly the last century as measured by the S&P 500 index. And the S&P 500, which is made up of the 500 largest publicly traded US companies, is the most widely used benchmark for tracking the performance of the US stock market. So with that tidbit out of the way, let's punch in our example. We're going to look at an initial deposit here of $50,000, and then we're going to be looking at 20 years of growth, and we're going to be using that 10% estimated rate of return, and it's going to be compounded annually. The contribution amount, we're going to leave it at 0 because we're going to assume that you're not putting any more money into this. You're just going to do that one-time investment. And now we're going to click here on calculate. And that gives us a total balance of $336,375. So in this example, that $50,000 investment could potentially turn into over $330,000 over that 20-year period through strategic long-term investment. For the second example, let's say with that same $50,000, you made bad investments and lost 100% of it. Well, that means you actually lost potentially about $330,000 in terms of the value of that money growing in a 20-year period, looking at that previous example. So when you lose money that you invest, you need to look at how much money you lost relative to what you might have made over the long run if you had avoided common mistakes. And I shared those 2 previous examples here with you in hopes to help you avoid taking a massive L in the market, because we would all rather be in that first example of slow and steady wealth being built over time versus example 2 of blowing up your account. So with that said, guys, let's dive into the 5 investing mistakes. For mistake number 1, let me start off by asking you a question. Have you ever had a friend ask if you like scary movies, to which you say yes, but the movie ends up being way scarier than you expected? Well, that scenario right there happens a lot in the stock market, and it's the mistake of not understanding your risk tolerance. In the same way that you might overestimate how much fear or excitement you can handle with something like a movie, the same thing is often true with investments. It's extremely common for people to exaggerate their own abilities and understanding and even tolerance to risk, only to find that some of them don't handle it well when actually faced with the emotion. One of the best ways to assess this is to consult with a financial advisor, but if you're not able to do that, keep this in mind. It's more likely that you're going to end up overestimating your own risk tolerance and then taking on more risk than you're actually comfortable with. So think about this as you assess potential investments and err on the side of caution if you are unsure. In general, stocks are higher risk investments, and US government bonds are considered to be the least risky. And speaking of emotions, the next beginner investing mistake ties in with this too. The stock market has boom and bust cycles, despite the fact that it has generated a consistent positive return over the long run historically. But during those bust cycles, the general outlook can become bleak. For example, during the last big bust in the market around the global pandemic, there was mass widespread fear and uncertainty. Nobody knew what was going to happen next, and many made the beginner investing mistake of panicking during the dips and selling. If you take a look at the S&P 500, the stock market has fully recovered and then some since the global pandemic. In fact, the return of the S&P 500 in 2024 alone was more than 23%. So if you panic sell your investments during the dips, you could potentially miss out on the gains that typically follow these periods of instability. Nobody knows for sure what's going to happen in the future, but generally speaking, it's usually best to ride things out. Let's move on to the third beginner investing mistake now, which is only focusing on trendy investments. Whether this is EV companies, fake meat startups, new e-commerce challengers, or something else, a common theme plays out with these new trendy investments. And that theme is that they often become overpriced, and investors can lose a lot of money. For me personally, I lost a lot of money investing into new age food and wellness companies in 2021. At the time, I thought I was investing in the next big thing, and it seemed like the market was wide open. But in both cases, the market rejected the product, and the companies went bankrupt. So instead of putting all of your money into the new and trendy industries, you want to also look at what is time tested. These trendy investments often trade for unreasonable valuations as a result of there being so much hype and attention surrounding the industry. Yes, it's possible that you hit it big investing in the next oasis. But as a hedge or bet against this, you could consider spreading your money out across both the new and trendy and what may seem old and boring. The next beginner investing mistake is going to be a common one for those who invest in individual stocks. As a general rule of thumb, it's best to avoid investing in unprofitable companies as a beginner or perhaps altogether, and here's why. Profitable companies have a proven business model that generates total earnings that exceed their total expenses. Unprofitable companies, on the other hand, do not have a proven business model yet. In my experience as an investor, that path to profitability is always more complicated than it seems, and many companies will just never get there. There is a huge difference between great ideas and great businesses. The simple approach you could take here is assessing whether or not a company is profitable before investing into it. If you invest in an unprofitable company, you're making a bet that they're going to be able to become profitable before they run out of money. But if you invest in a profitable company, they have already proven that the business model works and can be sustainable. So how do you assess the profitability of a company? One of the most popular methods is taking a look at the net income. A positive net income is going to indicate profitability. Meanwhile, a negative net income indicates that they are losing money. And guys, we've saved what I think is the biggest beginner investing mistake for last, and that is a lack of diversification. The concept of diversification is simple. You want to spread your money out across different assets or types of assets. And the purpose of this is so that you can limit your downside risk. The stock market is home to thousands of companies that all have unique potential risks and upsides. By investing in broad baskets of these stocks, or equities as they are called, you won't be as heavily impacted by the outcome of each individual company. And beyond just investing in many different companies, you also want to diversify into assets outside of stocks too, such as bonds, potentially even real estate, and more. So if you remember just one thing from this video, it's to diversify. But guys, I have a question for you for the comments below. What is the biggest investing mistake you've ever made, and more importantly, what did it teach you? Leave us a comment down below with your answer, and while you're down there, don't forget to drop a like and subscribe. If you want to learn more about diversified investing strategies like index funds and robo-advisors, be sure to check out our next video on how to start investing. We'll see you next time.